Welcome to Central Bank Central. I'm Kathleen Hays, here with you to talk about the jobs report for December. So it is the last jobs report of 2025 ahead of the first Federal Reserve meeting of 2026. A lot in this report, some surprises, some things confirming trends that many economists and perhaps people at the Federal Reserve are concerned about. So very happy to welcome back to Central Bank Central, Mickey Levy. He's a longtime Wall Street economist with a pretty darn good track record for assessing what's happening now and telling us where he thinks it's going next. He's a visiting fellow at the Hoover Institution and a longtime member of the SOMC, that's the Shadow Open Market Committee. So, Mickey, this jobs report has a lot of different elements. You've got downward revisions to job gains in the two previous months, and then a 50,000 worker gain payrolls for the month of December. Uh, Private jobs, about 37,000. But bottom line, good, bad, ugly? Does it force the Fed's hand in either direction when it comes to its next policy decision?
Kathleen, I'd say overall the employment report for December was fairly positive. Establishment payrolls were up. Yes, you did have revisions, particularly to October, which was kind of an iffy month because the revisions come, um, you know, following data that were kind of iffy because of the government shutdown. You also had a very positive household survey with big increases in employment, declines in unemployment, and a tick down in the unemployment rate. So all in all, in light of the negative perception of economic news, this report, you know, is consistent with the economy growing moderately, and I think accurately captures um, the overall kind of stable nature of labor markets with slower hiring but also slower firing.
Okay, well, let's get to that unemployment rate because it's a simple question. It did back down to 4.4%. It had been up to 4.6%. I think for a lot of people, 4.5% on the unemployment rate is as long as you're there or lower, hey, labor market looks pretty good. Start with that particular number because then I think we have to broaden this out. I mean, you've got so many things that are impeding job creation, and yet the unemployment rate stays high. But is it is this something that's again a positive number to see this unemployment rate falling? How significant is it?
Kathleen, the household survey was quite positive. Now, this survey is conducted by the BLS where they directly call households, and it tends to be very volatile month to month. And you've had the last couple months with big declines in the labor force, big declines in employment. But this number showed a big increase in employment, a big decline in the number of people saying they were unemployed, and then you also had the labor force, which declined a bit. So it adds up to a tick down in the unemployment rate. So right now at 4.4, um, it's still closer to its lows. This number suggested that it's may not rise further. Um, so I'd say overall, um, the employment report, is suggestive of an economy that's doing okay, a labor market that's, you know, maybe closer to a stall mode where businesses are slow at hiring, but they're also the initial unemployment claims show they're not laying off a bunch of people. So it's all okay. And then let me add one other point here that's
Okay.
critically important, and that is we also just got a report for Q3 on productivity, and labor productivity jumped quite a bit, reflecting the increase in private output um, relative to aggregate hours worked. So, the combination of, a moderate gains in the labor force and employment and you know increase in productivity, that's actually good news and consistent
Well, of course, if
with
productivity, higher productivity means you're not having to hire more workers, but you're getting more output, right? And that's certainly a plus, and it should be something that I guess ultimately maybe holds down inflation, right? But I especially want to get just also the fact you just mentioned, very important, I think, jobless claims. New claims on employment benefits around 200,000. So in the past, 3 or 4 years ago, we would have said, oh, great, it shows labor market's still strong. Now everybody still kind of puts that to one side. And does that have a lot to do with just this, like you said, firms aren't hiring as much, but they're uncertain, right? And maybe they don't need as many workers and they aren't laying people off. So I think to me, that's what's really hard then to say, oh, what does this report show you? Is the job market strong or weak? Should it be something that pushes the Fed, oh, better do more to rev up the economy? Or is it just we're in a very different sort of labor market situation than we have been in for a long, long time, if ever?
overall, I would characterize the labor markets as stable and reflecting a lot of business uncertainty and very efficient business practices, with businesses slowing down their hiring amid all the uncertainties, and but not laying off a lot of people. And Kathleen, we also have to toss into the mix the clamping down of immigrants
Yes,
and
exactly.
uncertainty about what that implies for future supply of labor relative to demand. So all in all, when I add things up, it's a stable labor market with results on employment that are consistent, adding in the productivity gains, consistent with moderate growth in the economy, which amid all the uncertainties and bad news on a day-to-day basis, I would give it a pretty positive assessment.
We started at the top of this, Mickey. One of the things we focused on was the unemployment rate, right? It's down to 4.4%. Many people think as long as you're at 4.5% or lower, you're in a pretty good state. And yet the Fed keeps talking about a weak labor market. This has been the biggest reason for the three rate cuts in a row at a time when inflation is well above target and has been there for a long time. So do you agree with the Fed? Should they be taking this stance on the labor market, the labor side of our dual mandate, when you're saying, hey, the economy is really going along okay, and does this make sense? And is this something do you think that's going to shift at this upcoming meeting?
Well, keep in mind the Fed has a dual mandate, and if we look at their three cuts in the end of 2025, when inflation was closer to 3% than 2%, it's just consistent with the Fed's historic prioritization of employment over inflation. And so, no, they should be looking at employment. And I think today's report, um, it comes almost as somewhat of a relief to the Fed having cut rates. Now they could size up the labor market, saying it's pretty stable. You have modest growth in establishment payrolls. As I mentioned, you had a very strong household survey with the unemployment rate coming down. So this tells the Fed that they're basically on track or consistent with their objective of maximum employment. Now, at the same time, you have healthy but not excessive growth in average hourly earnings, which is consistent with continued growth in disposable incomes, which means people are going to continue to spend, and that's good for the demand side of the economy. So all in all, it's today's report, um, you know, is consistent with the Fed's economic outlook
Yeah,
as its summary of economic projections indicated.
right. So, but if you think about it, we're talking about a jobs report where the net gain in payrolls from the establishment survey, where they get actually information directly from companies, right, about what's going on. 50,000, right? In a year ago, 2 years ago, at any time almost in history, oh, you've only got 50,000 jobs. The economy's sitting for recession. Oh, let's cut rates. However, fast forward to 2025, 2026, you've got AI, you've got artificial intelligence. Another reason people maybe are being more productive, as you just talked about. Um, and you've got the shift in, as you mentioned earlier as well, deportations, my immigration, etc. So, how much is that something people have to get used to now, including the Fed? There's things they can't control, but is that another reason maybe to step back and say, hey, we can't create jobs by cutting rates, right? And especially at a
We
time when there's so much uncertainty.
Yeah, we are definitely in a period where the economy and labor markets are adjusting, and they are adjusting. Um, I'd say more so to the clampdown on immigration, and it's yet to be sorted out how that affects the supply of labor overall and industry by industry. Um, AI, there may be anecdotal evidence on how it's affecting specific companies and specific industries, but it's way too early to make any uh, assessment of its overall impact on employment and productivity um, without, without a wide band of uncertainty around it. So overall, um, you can ask me if am I satisfied with an employment gain in establishments payrolls of 50,000? Sure. I think that's once again, if we add to that productivity gains, um, then it's consistent with healthy trendline economic growth.
So do you think there's going to be more concerned? Are you more concerned now about inflation being at 3% roughly now for a long time? I mean, we came down, but then it started going back up at the beginning of last year. In fact, that happened after the Fed had made a series of rate cuts at the end of 2024, right? You got down, then boom, it's gradually gone back up. What about is has the Fed lost inflation credibility? Obviously, the market seemed fine. Certainly, the stock market seems just very happy in spite of this high inflation. Um, what do you see there? And what is the Fed? Is the Fed just kind of giving up with this for a while? Just let us stay at 3% and see what the next Fed chair does and what happens there?
No, I think the Fed honestly believes that inflation will fall to 2%. There's no question that a key story about 2025 was inflation backed up. Um, Being an inflation hawk, I think inflation's actually going to recede a bit this year. And the primary reason for that is almost mechanical. The biggest component, particularly of the CPI, which is the shelter component that's driven by owner-occupied equivalent rent and rental costs. Those should come down. That big component should continue to decelerate pretty rapidly in response to the flattening out of the Case-Shiller Home Price Index. And that works with a lag. So that's an imputed number that automatically is going to be subtracting from inflation. And I think, aggregate demand, um, I believe it's going to remain in its moderate growth pattern, probably slow a little from the second half of 2025. And so all in all, I think inflation, we've seen the recent peaks. I think it'll drift down a bit. Um, I think a critical point to bring out about the Fed is it still has this target of 2%, but it's clearly allowed um, inflation to persist above that. And what the Fed has been trying to do is adjust its policy rate toward um, toward a natural rate that's consistent with its long run objectives. And in cutting rates last year, I think that's what it believes it has accomplished. And so for now, it should remain on hold until it sees, you know, the next breakout in data.
So, Mickey, when we talk about the Fed, one thing the Fed officials always talk about, we're fine, inflation expectations are anchored, or the doves, that they're not worried about inflation that's been high, around 3%, and staying there. This week, I think it was just yesterday, the New York Fed came out with its latest consumer expectations report. And their 1 year, and that's the one they usually emphasize the most at the New York Fed anyway, and a lot of other Fed officials, it actually went up 0.1%. That's a small move. But when you compare Michigan, University of Michigan Consumer Sentiment Survey, they've had some big jumps in certainly in medium long-term inflation expectations. As an economist who has watched this a very long time, what do you think about where inflation expectations are, and if there's a confidence in anchored inflation expectations not being a signal for rate hikes or something? That'd be really extreme. What do you think of that?
Kathleen, you have been discussing survey-based expectations of inflation. And I think consumer inflation expectations, which have gone higher, reflect just the cumulative impact of 5 years of inflation has led consumers to just be wary of higher prices. Um,
Hmm.
the Fed tends to put more focus on market-based measures of inflation expectations, like the 10-year forwards or the 5 year, 10-year forwards, and those have been well anchored. So the Fed likes those. Um, so with that, you know, with the Fed perceiving inflationary expectations are well anchored and following its three rate cuts of last year that bring its inflation adjusted policy rate uh, within the range of a neutral Fed policy,
Okay.
according to the Fed. They'll be on hold in January and probably the next couple meetings.
And probably the next couple of meetings. So that gets us, I think, the big picture of uh because how long they're on hold. Whether or not they decide to keep cutting rates, you know, second half of the year, first half of the year, whatever happens. It's going to be determined a lot by what the economy does, what prices do. So, what is your view right now of 2026? Where is this economy going? Is the worry and negativity about what it's doing and what's going to happen next warranted, or is there a chance that 2026 is going to be a decent year for the economy?
Okay, despite all of the uncertainties and really erratic policy making from the Trump White House, um, I think 2026 will prove to be an okay year. Keep in mind, you don't have major imbalances in the economy. Inventories are low. Um, Employment is not excessive relative to output. So businesses are in a good place. In addition, you have the tailwinds of three Fed rate cuts, 50 basis points lower in mortgage rates in the second half of 2025, which may stimulate the housing market. And in addition to that, you have some fiscal stimulus, and that's coming in the form of, the lower rate schedules that were enacted last year, which should increase tax rebates this spring. And then along the way, in addition to the extension of tax cuts, you have business expensing of R&D and the like. So the combination of a little bit of fiscal stimulus, monetary accommodation, and sound economic fundamentals, I would say 2026 will be an okay year with sustained moderate economic growth.
Okay. So, in terms of the Fed chair, what are you looking for there? And how is that going to affect not only what the Fed does, but how the markets react, what the bond market does, what a lot of forces are unleashed or not unleashed here.
Okay, Kathleen, it's just clear the new Fed chair is going to, right out of the chute, support President Trump and favor lower interest rates. And normally at the Fed chair carries a lot of weight and much more than one vote. And then we have to see how further changes in the Fed evolve. But I do expect the Fed will be tilting toward lower rates. And once again, um, that would be that probability would be enhanced if you do get some more positive inflation data.
Okay. And that's a pretty big if. In terms of
Yes.
in terms of the bond market, though, there used to be inflation vigilantes. Remember that? Bond market vigilantes, I
Yes.
should say, vigilantes. Um, have they gone away? Is there, has a long-term seasoned investors changed their mind about inflation? There's so much demand for U.S. bonds that it kind of doesn't matter right now because the rest of the world has its own uncertainty? And in fact, there's always questions, of course, about fiscal dominance and what that's going to mean. When the deficit gets so big, the Fed has to buy more and more and more bonds and won't be able to fight inflation. What do you see there?
Okay, so let's set aside this issue of fiscal dominance for a second and look back at the three rate cuts in 2025 from September through December. During that period, as the Fed cut rates, you had short duration yields come down, and the bond market yields kind of moved sideways. So you had a steeper curve. The dollar initially went up, but then ended on quite a weak note. So, the Kathleen, if you asked the question, are there any limits to the Fed cutting rates in 2026? I would say the key limitation will be signaled by markets in the form of some combination of a steeper yield curve and or lower dollar. And if that were to happen, uh, the markets would be telling the Fed clearly don't cut more. And that will be conveyed directly to President Trump, who tends to respond to markets.
Yes, yes, he does. So, in terms of getting back to the Fed chair, again, you do think you think that whoever is there, from Chris Waller to let's say Kevin Hassett, that they will have an influence and they will be more dovish. They'll be pushing for more cuts. Who do you expect? If you had to say, who would you like to see, and or who do you think the president is going to select? It could be any day, it could be any minute.
Whoever the whoever Trump nominates to be Fed chair will be one, the candidate will be a loyalist who, at least out of the chute, will completely support Trump's demands for lower interest rates. How long that lasts, that's another issue. But initially, it'll be somebody that Trump perceives to be a loyalist.
Okay. And what do you think again when you have this, you have a pretty positive outlook for the US economy.
Yeah.
You do think, as an inflation hawk, I love when you said that, that there are almost technical factors that inflation is going to start coming down, which will be great for the Fed and for whatever it wants to do next. Um, how do you think that the committee overall around this next Fed chair will stand up and or support? How are they going to deal? The Fed governors, the Fed bank presidents, how are they going to go along with that kind of view? Because basically, once you're Fed chair, you can do whatever you want, and if you have a 14-year term at the Fed, you can do what you want too.
You can do what you want, but the Fed tends to operate, you know, as a pretty close committee. And what we have experienced in recent months, and what you most likely will experience in 2026 and beyond, is more dissension. And with so many FOMC members, as soon as the blackout 2 days after the FOMC meetings end, go out on the speaking tours, you're going to hear these dissensions and different views. And you could see some changes in the committee composition. And so what's always been difficult for the markets is when you have so many FOMC members speaking publicly, you have to handicap which statements and by whom are important and which are not. And it's going to be a very interesting year. And let me add, while your focus has been on what's the Fed going to do next on interest rates, you very well could have, depending on who is put in his chair and who and the impetus from other parts of the committee, you very well could have some initiatives to alter governance of the Fed that could shake things up. You very well could have the Fed looking into the ways to modify its summary of economic projections, add scenario analysis. There are a lot of different things that could be new for financial markets in their critiquing and observing the Fed.
Okay, well, a lot to look forward to in 2026. Mickey Levy, thank you so much for joining me here again on Central Bank Central. I really appreciate it.
Thank you.
Okay. Mickey Levy, of course, longtime Wall Street economist who has devoted his life to looking at this economy and telling us what it's going to mean for investors, for the Fed, and more. He's also a visiting fellow at the Hoover Institution, longtime member of the Shadow Open Market Committee. I'm Kathleen Hays, and this is Central Bank Central.